Welcome to another Ronel Talks Money Show. Now, today we're going to talk a little bit more about an investment property partnership. But before we get in there, I want to again encourage and invite you to please subscribe to the channel, and you will see there's also a link in the description below where you can enter our giveaway competition, where we have prizes every month to give away, and you can also win one of my books, Financially Fit and Wealthy, that I give away on a monthly basis. So please join us by subscribing to the channel and also enter the giveaway competition. Now, today, talking about investment property partnerships, I have Hannes Dapper with me, and I just want to quickly share his bio with you. So Hannes founded the Share Your Wealth in 2011. Hannes has successfully completed a BCom degree in entrepreneurship and currently working on an MBA in leadership and management from the York St. John's University in London. Hannes is a visionary and serial entrepreneur. He believes in the philosophy of giver's gain and builds his life and business on the key success factor, share your wealth. The more you assist other people in their journey to success, the more comes back to you. Now, what a lovely philosophy is that to have in life. And then also Hannes is probably the only person who did the blow-across bungee jump with the unfair advantage that he couldn't see how high it was. Sure, yes, I have to admit, I don't even know if I would do that under those circumstances. So Hannes, well done. But being a regular guest on All About Property on DSTV makes him a familiar face in the property investment landscape in South Africa. Apart from property investment, Hannes wants to help people broaden their boundaries through his motivational and inspirational talks focused on the blind inspiration. Hannes, thank you so much for joining us today and welcome to the show.
Thank you, Ronel. It's a great opportunity. Thank you for having me.
Okay, so let us dig into it. Maybe you can just start off by sharing with us more about the DJV Groups and Share Your Wealth, and what do you do?
Okay, we distinguish between the two groups. Share Wealth is an umbrella company which basically holistically looks at Share Your Wealth, building a resource base for individuals wanting to move forward in the property space, irrespective of whether you're a beginner or intermediate or advanced, to expand your horizons, access to distressed properties, access to education, access to legacy planning, etc., etc., etc. The DJV Group is an initiative, investment partnership initiative that we've created on the principle of Ubuntu that really goes hand in hand with Share Your Wealth. A lot of individuals want to get involved in the property space, but they do not have the resources at the moment, or some people are more advanced and they've reached a ceiling in terms of the kind of capital that they can raise with the bank. And therefore, we've created this partnership instrument that will actually assist people to get in, to expand their footprint in the property market without any additional exposure to themselves. That makes sense.
Okay, excellent. Yes, I think I've attended one of your webinars. It was probably towards the end of 2019 when I was in Cape Town. And what really excited me about this investment opportunity is that it can definitely give access to a lot more people in South Africa to be able to own property. But maybe you should, from your point of view, just tell us what why did you decide to venture into property?
Okay. The property has over centuries been the only instrument that has consistently outperformed inflation. It's the only geared instrument that we can safely use to grow our money at a higher rate. If we invest in the financial markets, for example, if we just invest without any gearing meaning that you kind of inflate the amount of money that you are dealing with. So you've got a certain portion of money, but you're using other people's money or the bank's money or a broker's money to accelerate your growth. In the financial markets, for example, there's a relative amount of risk involved in the fluctuations in the market. If we look at the property space over centuries, I mean, this is one of the things that Robert Kiyosaki has been saying from his first book, is that it's a consistent grower. Even in the worst of market conditions, we see small pullbacks, and then it grows again. I mean, if we look at Zimbabwe, a country where the economy crashed completely, even the value of property has recovered itself there. So in the long term, those are the two key factors. It's a consistent grower, and we're able to gear up and use other people's money to get a maximum return on investment, meaning that the maximum growth on the amount of capital, actual capital, money down that you are taking out of your pocket and investing to get a gain from that.
Okay. Now, Hannes, I think everybody's probably asking you this question quite often. If we think about what's happening in the South African landscape, and you've also mentioned now what's happened to Zimbabwe and that they could manage to recover, but would you say that it is still within South Africa a good option to invest in property?
Well, in certain market segments, if we look at high-end properties, that's not a good investment. If we look at commercial, so let me just unpack that a little bit. So high-end properties at the moment are taking a big slump, especially, I mean, there was a carte blanche interview recently about decreasing pricing, especially in Pretoria East. But all around the country, even in Cape Town, there's a massive decrease in high-end kind of properties. Okay, so that's not a good way to go. Commercial property at the moment, I think COVID has changed the climate of commercial property completely. If you walk in malls, you see there's several vacant properties. I mean, there's in Bryanston, for example, there's properties that are renting at half the rate that they used to rent just in order to occupy them. My philosophy is that the career path for the individuals in South Africa is they move from rural areas to rent by bed options in inner cities. So I think that's a really good investment. Then the next step is for them to move into two-bedroom sectional title apartments. So there will always be, I mean, for the next 100+ years, while we've got a developing country, there will always be an over demand for two-bedroom apartments. And therefore, we only invest in that segment of the market, and you'll see consistent equity growth implying the increase of the value of your property on a monthly basis. And because there's a high demand for rent, you will also be able to increase your rental on an annual basis, as you should, with at least 10%.
Mm-hmm. Okay, that's excellent. Yes, I totally agree with you. I think there's definitely a big move within the bigger population moving into property, wanting to own their own property. And I think that is what should encourage people to still get involved in property investments. But now you have created an investment property partnership, which is quite a unique concept, and you should maybe just explain that to us in layman's terms.
First of all, it's not an offer that's open to the public. Based on FSCA regulation, you're not allowed to offer shares in a private company on a public platform. Therefore, the career path to enter one of these partnerships is to become part of the Share Your Wealth Property Club, which is a free club. It's just there's no fees attached to it. It's just becoming part of a community. Once you're part of the community, you gain access to property investment partners. And the way there's a structure, there's a ring-fenced property investment company. Each one of these companies have 1,000 shares. 300 of those shares are taken up by Share Your Wealth. Other 700 shares are available to Share Your Wealth Property Club members. Sorry, we've actually restructured our pricing and access points to the extent that a person is able to take up a share for as little as 570 Rand a month. In our 2020 structure, the minimum entry point was 2,500 a month for a bundle of 5 shares. Now, all costs included. So Share Your Wealth makes money in 2 ways. The biggest part is holding 30% shares in this company. We take no liability to any other shareholder. So we sign surety, we back it with our own resources in order to grow the company and buy property. Then your total contribution over a period of 60 months, for example, if you're paying 570 Rand, is about 30,000 Rand. And that's your contribution plus costs. Okay, and the cost is about 5,000 Rand. So those are the only administration costs that Share Your Wealth will ever charge. So we're not charging, what a lot of funds do is they charge massive management fees and administration fees and offices and everything else. So all of our infrastructure is covered by our operation in Share Your Wealth. We're not taking any of those expenses from the property investment companies, which allows us to remove all that expenses. Where if we compare it to a fund, we don't have to pay big buildings and administrators and fund managers, etc. So all the profits that are generated from the purchase of the properties, the equity growth, is reinvested in buying more properties over a period of 5 years. So the value of your share will keep on growing. At the moment, our average annual increase in the value of shares is about 20%. The compounded effect of that is about 300% over a 5-year period. Then after 5 years, your shares become transferable. So you are locked in for a period of five years, which you have to contribute. In month 61, you can start selling your shares. Okay, so I don't know if you want to go into more detail in terms of how fluid or how what the demand is for those shares after 5 years. Can I go into that now?
Yeah, definitely. We would like to know.
Okay. So because we create a marketplace, we currently have a lead stream of about 1,500 to 2,000 new people coming in as potential customers every month, and every company has between 140 and 700 shareholders. So we've created a marketplace that believes in the system. A lot of our clients buy shares now, and based on the performance going forward, they take up a second and a third share in another company. So come 5 years down the line, the growth on this portfolio builds up momentum. So the growth in year 1 to 5 is actually a lot less than it would be in year 5 to 10 because of the accumulation of property. Okay, so there's a much bigger value attached to that property in terms of potential growth in year 5 to sell your share to another individual. Our long-term plan is probably not to run this program for more than 15 years, in which case we would very, very likely liquidate the whole portfolio. Liquidation meaning selling off all the properties, and then we would pay out all shareholders in dividends. Because essentially it's not something that you want to keep running forever. It's a retirement plan. I think for myself personally, why I'm involved in this and why I'm doing it is this is a big portion of my own retirement plan. And as you can see, I'm growing quite old. So, I want to retire at 34. So I've only got 15 years left. Okay.
No, I think that that's always good to have big dreams. So you should go after those dreams. And I think you definitely came up with a good solution to achieve that. But you should maybe also just explain to us, a lot of us know and understand the real estate investment trust. And how is this different from a REIT?
This is a company, so it's a partnership between investors. So it's purely based on the principles of the Companies Act, where a fund or an investment trust is a regulated instrument. The moment something becomes regulated, it is an increase in cost. So the safeguarding mechanisms in terms of this company is the company. Okay, so we completely refrain from staying outside of the parameters of FSCA regulation. Okay, it's really just a community of people coming together, deciding to partner like a stokvel. Some principles of a stokvel. It's just a private company that is structured with a very solid memorandum of incorporation. And just to explain that, a memorandum of incorporation is the founding document of a company that explicitly rolls out and explains the rules and regulations and the obligations of directors and the rights of shareholders, which can never be changed. That document is publicly available on CIPC. And if the directors want to make any changes that influences the well-being of shareholders, it has to be approved by the majority of shareholders. So that's a very solid document. In terms of the Company Act has become increasingly strict about the management of companies. The fiduciary obligations of directors are to such an extent that there's no more fines or anything like that. It's really jail time. So if we make any mistakes within the management of this company, it really implies that the directors are going to be criminally taken on. So that creates a big safety net within the structure, but it's not a structure for the masses. It's really something unique that is focused at a small market. We don't advertise it publicly. It's really for people with appetite for getting into the property space. People also ask, why is this not a pyramid scheme? Okay, so the way pyramid schemes work is they use the money that comes in from new investors to pay the money from old investors, or even to pay the interest from old investors. This is a ring-fenced company. Once that 140 shareholders or those 700 shares have been sold, that company is ring-fenced and it's done. There's no changes made further. No other people are coming in. In funds or investment trusts as well, it's an open-ended scheme. So, based on the performance of it kind of runs parallel, irrespective of how much money is in the fund. People can come in all the time. Okay, here it's ring fence. So if you're part of the first company that we created is DJV Property 20. So if you're a shareholder to DJV Property 20, you'll remain a shareholder in DJV Property 20. And until that 5 years finished, there will be no changes in shareholders. No other money will come into the company besides the contributions of the owners of that 700 shares. So for every new venture, we create a new company. Okay, does that make sense?
Yes.
It's quite a mouthful.
Yes, no, it absolutely does. I think if you can also share with us, you've mentioned now already a couple of the pros, but just maybe summarize again, what are the pros and the cons involved? Okay.
The biggest advantage is that you're going to get maximum growth on your on the capital that you contribute, because you're using a geared instrument. So we we use the contributions of shareholders towards 20% deposits on property. The other 80% is financed. Okay, so within the first year or two, we can refinance that initial deposit, and we obtain a rental surplus in terms of how we rent the property. So we can then apply that same deposit to another property. So the portfolio grows quite rapidly because it's a company in a corporate structure. We are able to negotiate rates and facilities on a corporate level, which is something that individuals can't do. I mean, to give you an idea, the net asset value of this company after about 40 months of operation is about 25 million, and it's literally increasing with about 20 odd million a year. The disadvantages is that it is an entrepreneurial enterprise, but the historical performance of the market is relatively stable. But we need to understand that no specific results are guaranteed. Besides the fact that we're not allowed to guarantee those results, we can show you what we've done in the past, but it is a private partnership between individuals. Okay, so but once again, if any decision is made, I, as the managing director, have certain rights, and it's pretty much limited to buying properties in the range of under R1 million, and I'm, only allowed to use investor capital towards deposits. We're not allowed to refinance equity. So there's a whole lot of rules that's been structured by high-level attorneys to ensure that the equity of shareholders will always be protected, and that there will be a resale value at the maximum value after the fine.
Okay, and then you've mentioned now about the returns and what the returns the investors can expect, more or less, even though it's not guaranteed. But maybe you should just clarify, can you only receive those returns basically at the end of the 5-year period, or would it is it possible to receive some returns like in throughout the investment period?
Okay, yeah, it's because it's a buy and hold principle, and because we accumulating property and we're reinvesting everything that we, all the capital, the equity, the deposits are reapplied to new properties consistently. Unfortunately, there's a lock-in period for 5 years. So the principle is kind of, you can't have your bread buttered both ways. Investing slowly and getting immediate returns. You need that money to accumulate, and the property base to accumulate in order to get the maximum return. So after 5 years, you are able to sell one share at a time. So let's say you've bought 5 or 10 shares. This is what a lot of people do. They would, for example, over a period of 5 years, they would sell 2 shares a year. Then they get the best of both worlds. They get immediate returns and they can start doing their own thing. And essentially, this is, we're all about empowerment. So the idea is for you to create this, use this as building a tool to build a nest egg, so that you can start expanding your own portfolio. Okay, because we're not diligent enough to save properly. If we save in a very low interest-bearing account. So we're not really getting optimum return. So this is part of your 5-year plan. So you sit down and you say, I'm going to educate myself over the next 5 years. I'm going to become an expert in property investment. Over 5 years, I'm going to have this 2 or 3 or 500,000 rand. I'm going to know how to utilize it myself in order to go and buy 5 or 6 properties, so that in 20 years, when I need to retire, I can build a portfolio of 50 or 60 million rand so that I can retire on that. Because essentially, I mean, the figures that financial advisors give us, and I get shoot down, it's by financial advisors all the time. The fact that I haven't been sued is a miracle. But the actual figures that they project for our retirement, we actually need 20 times our current income, 20 times your current annual income to retire today. So if you're going to be retiring in 20 years, you're going to need 20 times your annual income at that time, just to maintain your lifestyle for the rest of your life. So there's no way that alternative instruments, property is the only instrument that will allow you to retire financially free.
Okay, and what would you say, who would be the typical investor or the profile of an investor who this kind of partnership would appeal to?
Okay, there's basically two types of individuals. One is the entry-level person that can afford anything between 600 and 5,000 Rand to invest in something that will accumulate in funds in order to move to the next step. The other person is a person that is already overexposed in the property market. With the new Credit Act and bank regulations, it's quite hard. At some point, you reach tipping point where the bank won't give you any more money. So then this is a great tool to expand your footprint in the property market without taking on any additional liability.
Okay, and then you said so the minimum investment requirement would be about 500 Rand per month.
Yes, they call it 600 Rand, 572 Rand. That's the
572. Okay, and that would be basically lock in for a period of 5 years.
Yes, so that's for one share out of 1,000. So there's 700 shares allocated to or allotted to external shareholders. So that's one share out of 1,000.
Then what a lot of people are often quite concerned about is that they cannot get into property because they don't have a good credit record. Is it something that is important in this instance? Do you look at potential investors' credit records, or how important is that?
Okay. Don't do credit checks. However, what we do is we do ask you for your latest payslip and 3 months bank statements. We only allow look. We don't want investors that have debit bounces, etc. It creates risk for the other investors. So if you can prove your affordability with the payslip, we will only allow 2 shares per every 10,000 Rand that you earn, and then there's no bounces over the last 3 months on your bank statement, then you're good to go. But if your financial behavior at the moment is good, great. It is important that you understand that you need to be able to maintain this expense for 5 years. If you do default during the process, we do have the right to, after 3 months, resell your share to another shareholder at 50% discount of what you have contributed to date. So you need to understand that this is a marriage for 5 years. There's no way out without losing at least half of your capital. There's something else I wanted to say now. However, I mean, things like COVID happens, so there is some level of leniency. We are human, and I mean, we've built this company on the fact, on the principle of humanity. So I think what I communicate with my financial team is, as long as people are talking to us, there's a lot of people in COVID that phoned us and said, I've lost my job. Can you please freeze it for 6 months until a further notice? Then we're happy to accommodate that, as long as we don't have to chase money. We don't have a big financial department, so we don't do credit control. We don't want to chase people and call them for money all the time.
Absolutely. And then what are the other type of risks involved, and how can a potential investor mitigate it, but also how do you mitigate it from your point of view?
Okay, so like I mentioned before, the important things is for you, the crux of this investment is for the equity. The equity meaning the increase in the value of your share. So it's kind of an intangible growth in the value of your share. So there's 2 ways that is going to happen. The one way is that the value of the properties in the portfolio is going to increase. So whatever the value of that property increase, 1 out of 1,000 Rand, 1 Rand out of 1,000 Rand will be yours, okay, in the growth of equity. On the other hand, we're going to reduce the outstanding bonds by at least 5% per year. Okay, so 1 Rand out of 1,000 Rand that's made, they will be yours. How we protect that is, we're never allowed to refinance the equity, the increase in the value. We're only allowed to refinance funds that we've invested in the property. So for example, if we buy a property at 1 million rand and we use investors' capital of 200,000 rand to pay a deposit on that property, we will only be able to refinance that 200,000 rand, and then we'll be forced to put it down as a deposit on another property. That way, investor capital will never vanish, will always remain in the balance sheet, and we will never interfere with the growth of the value of your shares. Okay, so that's the biggest protection mechanism, and all of this is written into the MOI, the Memorandum of Incorporation that I referred to earlier. So any behavior outside of that is a criminal offense.
Okay, and in terms of legalities, what are the legalities involved?
Okay, so there's a very comprehensive structuring process. The first step is to sign what we call a letter of intent, showing your intention. Once your first debit order has passed, we will send you a bundle of documents, including number one, a shareholders agreement, which is a pretty comprehensive agreement that you can have your legal team check as well. We've worked on this for the last 6 years. We've really mastered it quite well. We'll also sign what we call a subscription agreement. The subscription agreement entitles you to your shares over a period of time. So your shares will be accumulated in trust. In trust, meaning we have a trust attorney that will have the actual share certificates, will only be handed to you on the day of completion of your subscription agreement. That's if you pay cash up front, then it will be issued to you immediately or given to you immediately. If you pay it over 5 years, it will only be given to you once you've paid it. But the shares and the value or anything that goes with that remains yours. Okay, it's just a protection mechanism for us, because if we give you the share certificate, in advance before you've delivered, then you've already taken possession of the value, the full value. Legalities. Okay, so the next, lost my train of thought there. Okay, the third agreement that you'll have to sign is what we call a trust agreement. And a lot of people confuse this with the trust entity. It refers to the trust between partners. So it's basically just a goodwill agreement stating that we are in goodwill entering a partnership between Share Your Wealth and yourself, so that we will build a company related to property investment.
Okay. And then you have mentioned now that it is over a 5-year period, but what are the options if an investor, either something happens, like you mentioned, COVID or whatever, but maybe after 3 years or 4 years, they decide that this doesn't work for them, or for some reason, they no longer want to be involved. What are the options then?
Okay, so there's really no options. Like, it is a 5-year commitment. So if you decide, there's a sliding scale. In year one, we'll sell your share at a 75% discount of what you've contributed. In year 2 to 4 at 50%, and in year 5 at 25%. So the longer you're in, the less you lose, but you're still going to lose capital. So it's very much like an endowment. It's a fixed 5-year commitment. If you run into financial trouble or something like that, then of course we will accommodate you. We've accommodated people up to 12 months because it doesn't really influence the liquidity of the company if somebody freezes for a period of time. But you're going to have to make that 60 payments in order to realize the value of your share.
Okay.
There has been instances where we've transferred shares from one person to another, that have taken it over. Okay, but then you need to bring that person to the table. We need to vet him, and then in that case, we'll transfer it. Okay, if you die and it goes in your estate, we take life insurance on all shareholders, buy and sell insurance, so that we can buy out immediately in the case of somebody or of you passing away, because the relationship is between you and us. We don't want to be dealing with your inheritors. because they don't understand the concept, they don't believe in it, and we work with people that want to work with us. In that case, we'll immediately buy you out, and then the shares will belong to Share Your Wealth.
Okay. Okay, and then you've mentioned now that there's not a lot of costs involved, but maybe just expand on that a little bit in terms of the admin fee. How much are you looking at?
Okay, so the share subscription is 24,000 Rand per share, which you're paying off, or you can pay it up front. If you pay the full amount up front, the administration fee is 6,000 Rand excluding VAT. If you pay it over a period of 60 months, obviously we're financing it ahead of time, then it becomes 8,500 Rand excluding that. But that's all included in the monthly payment of 527 Rand. Okay, so it's obviously ideal to pay cash up front, because then you save a lot. Obviously, there's a cost component for us to have to finance the process over 5 years. We have to sell our debtors book, for example, at 20% discount. So we need to recover that cost somehow.
Absolutely. And then what about the tax implications?
Okay, so we'll need to structure your estate. It's preferable to keep these shares in a company. Very much like sale of property, there will be a build-up of equity gains tax, capital growth tax. So the ideal is to never have to sell the share, but rather just to transfer, the company into somebody else's name. Okay. At the end of the day, my accountants always says, you pay the government what you owe them, not what they ask.
Yeah.
Okay, so we have to structure it in a way that's most tax compliant to you. But at the same time, with an investment that's going to give you a 300 or 400% return over a 5-year period, compared to vanilla investment that's going to give you 30 or 40% over a 5-year period, if you're going to sacrifice capital gains tax or a portion of capital gains tax, when you're structuring your company properly, there's no way that you're ever going to get away from it. So it is something that you have to. It will definitely reduce the return on investment, but the same rules will apply to any other investment that you're entering.
Yeah, and I think it is best for any potential investor who wants to get involved to, take their personal circumstances into account and to check with a tax advisor or their accountant what will the impact be on their personal tax affairs. So, because remember, it's never kind of the same for every single individual. So, we would definitely encourage you to chat to your tax advisor or your accountant just to make sure that you understand the implications. But then, Hannes, I think the last question I want to ask, there's been a lot of things happening in South Africa recently, again, in terms of schemes that just go haywire. So what are the things that, or how can an investor make sure that when they are dealing with you guys, that you are a reputable and a legitimate company, and that you will not, like what we've seen now recently, take their money and run away with it? So what are the things that you can give them that kind of sense of comfort?
Well, firstly, you can validate the company and directors on CIPC. Secondly, if you go on Lightstone and you go and do a property search on DJV Property 20, for example, it will give you a list of companies that belong, or properties that belong to this company. We do circulate management accounts every 6 months, so you can compare that. We do completely independent audits once a year. It's required in terms of the public scoring of the company. So you've got access to the auditor, and as a shareholder, you've got the right to full transparency. So if at any time you're uncertain about anything and you want to validate anything, we must adhere to responding to a request. But I think those are the biggest checkpoints. I think the things that you want to know is, are we investing your money in property? Is the company legit? If you go and look on IPC and you see, you can find the company, you'll see, I'm the director. The auditor also holds the share register that's publicly available to shareholders. So there's a lot of ways to check it.
Okay, and you obviously also have a registered office as well.
Yes, yeah, absolutely, yes.
Okay, so Hannes, thank you so much for joining us today, and thank you for sharing more and explaining to us what this property investment partnership is all about. We really appreciate your time, and we want to wish you well going forward. But then I also just want to all the viewers say thank you for watching another Ronel Talks Money Show. Remember to subscribe to the channel. Remember to have a look at the link within the description to enter the monthly giveaway competition, where you can also win one of my books, Financially Fit and Wealthy. And then also, if you have any comments, any questions that you would like to ask, I'm also going to share Hannes's website details so that you can get in touch with them. But thank you for watching, and then we will see you again at the next Ronel Talks Money Show.